Very excited today to have a guest with InvestTalk, Haren Bhakta, who is a CFA charter holder and the mind behind the Insider Ownership Index. Excited to talk about his background, how he came up with the idea, and his opinion on where the markets are and maybe where they will be going from here. And so, Haren, just to give people a little bit of an introduction, how did you get started in finance? What led you to the CFA designation and eventually towards index design?
Yeah, Luke, first of all, thank you for having me. So what led me to the stock market in the first place was when I was 18, I think my grandmother gave me like a really small amount of money, said it had to be in stocks. This was in the 90s. Mm-hmm. So it actually got me out of bed at a reasonable hour, something that pretty much the only thing that can get me out of bed was that, yeah. So I woke up early, started trading stocks, thought I was smart, as everyone did in the 90s. Then I lost all my money in 2000. So I kind of forgot about stocks. And then I got back into it when I was getting my MBA, found out about the CFA, and that's when I decided to pursue a career in the investment industry.
And where did your career start within the investment industry? Yeah,
I started at Merrill Lynch in 2010 as a financial advisor, going out and trying to get accounts. Cold calling, stuff like that. Then I moved over to Morgan Stanley, spent 5.5 years at Morgan Stanley. Eventually, I started my own investment advisory business in 2017. And then last year is when I launched the Inside Ownership Index.
I think anybody who's worked within the financial services industry understands that most of the products that are created are because they're trying to fill some sort of gap between what investors have available to them and what investors may want or may be beneficial for them. And then so, what problem or gap then did you see within what was available in the market that made you think about inside ownership and led to you launching the Inside Ownership Index?
Yeah, well, I think it comes from the idea I got while I was at the Berkshire annual meeting. So I was sitting at the Berkshire annual meeting in 2024. Someone asked Warren Buffett a question about indexing. And it just got me thinking that, at the time I was a big shareholder in Berkshire, and I was like, I don't want to own more Berkshire after Warren Buffett's gone. And that's exactly what the S&P 500 will do, because the S&P 500 is what's called free float adjusted market cap weighted. Now, why
don't you explain that too for anybody who's listening?
Yeah, so free float adjusted just means that when they calculate the market cap, they exclude closely held shares or shares held for control purposes, which Buffett's A shares meet that requirement. So when Buffett dies or sells his stock, those shares will eventually be converted to B shares. Therefore, the S&P 500 will be buying Berkshire shares because they would be expanding the market cap of Berkshire by including those shares. So, and same thing would happen with Jeff Bezos and Amazon. And it just got me thinking that, God, I don't want to own more of these companies when these founders are gone. Buffett wasn't a founder, but he's kind of considered a founder of modern day Berkshire. And same with Tesla. I don't want to own Tesla or not as much of it when Elon's not there. And that's what kind of evolved into this index. And I really believe in a low cost strategy, offering that most people, most money managers don't outperform the passive indexes after fees.
Yeah. No, I think fees are a big part of the industry, right? It's something that you've seen over time, a lot of fee compression. Things used to be far more expensive. You'd pay brokerage fees, commission fees just for trading. A lot of RIAs back in the 90s when you were getting started were probably commission-based in terms of the fees they're getting. And now the industry is moving more towards this fee-only advisory approach. And I think that definitely fits in well with where the industry is going as a whole. Now, you mentioned that the S&P 500, it is free float market cap weighted, right? And so that's probably the biggest difference between that index and your index. Can you talk a little bit about the construction methodology, what companies generally are eligible to even be in the index in the first place, and then how you define and measure this inside ownership?
Yeah, so the starting universe for my index is the S&P 500. So it has to be a constituent within the S&P 500. And then I take the top 100 from there by value of the shares owned by insiders. So essentially, I'm calculating the market cap by using only the shares held by insiders. And I cap that at 5% of the shares outstanding. So if, for example, if Jeff Bezos owns 10% of Amazon, I'm only counting 5%. And this is to reduce overexposure to certain stocks. And indexes also have constraints to be tax efficient. So there's some efficiency rules there that I follow. But basically, I take the top 100 that filters through based on inside ownership. And it's rebalanced quarterly.
Rebalanced quarterly?
Yeah.
Are there any other constraints on holding percentage, or is it just a blanket 5% constraint?
There's some constraints. So all indexes kind of have a constraint where no one position could be over 25%, which is not a big concern for my index. But what the other concern is all positions above 5% cannot total over 50%. So if you take all the positions that are above 5%, add them up, and it can't be more than 50%. So I have to adhere to that. And occasionally there are quarters where that does happen. So there's a formula to kind of reduce that exposure.
What do you think, and for those watching, within the investment management industry, when you come up with a new strategy, a new index, you oftentimes do a lot of back testing, right? And so how did this perform over several short, medium, long-term periods relative to the more traditionally market cap weighted approach? Because that is, I think, probably the most often used approach across indices, within the S&P 500, certainly all the Russell indices, FTSE, MSCI, they all do this market cap weighted approach. And so how did that perform within back testing relative to that?
Yeah, so I back tested 20 years. I wanted to back test more than that, but it was just hard to get the inside ownership data prior to 2004. It's much more difficult, especially because a lot of those companies in the S&P 500 no longer exist, or they either went bankrupt, got acquired, and it was just really hard to get filings that far back for the proxies anyway. But for the 20-year period, I did backtest from 2005. $10,000 invested in the S&P in 2005 today would be around 75,000. In my index, it would have been 110,000.
What were the primary drivers of that?
Primary drivers of that were, for example, the top five, the five of the Mag 7 today are founder-led, high inside ownership. So my index overweights those companies. And typically innovation comes from founders. And so my index captures more of that.
Yeah, I think one example that we talked about before this was Apple, right? You have Steve Jobs, very visionary, obviously back and forth between actually leading Apple, but still, the company was leading in innovation. And then he obviously no longer with the company. Tim Cook comes along. Tim Cook is very much about maintaining the profitability of the company, but not really much innovation in the past 10 years from Apple, right? Just polishing an apple. And that kind of, polishing an apple. But that essentially underscores the point, right? That founders help to lead the innovation at a company. And so it might make sense from a sensibility perspective to no longer want to be as invested when those founders leave. So that's good to see in terms of the back testing. Was there anything that surprised you when you were doing research on this, that maybe you went in with an initial thought about something you might see with this type of methodology, and you were surprised by the actual outcome?
Yeah, so I was surprised by the individual sectors. So the way my index performed, even within the subsectors of the S&P. So I recently launched indexes with my methodology on the individual sectors for healthcare, finance, and technology. So I was pretty shocked by the outperformance that the technology had, because a lot of people thought that the outperformance of my index was due to it happened to favor technology companies.
Of course.
But when I compared it from just the technology to technology sector, we also had a large outperformance. And that's because I think it takes a founder to innovate. And yeah, so I was pretty shocked when I went through like even the financials. Yeah, I had an outperformance over the 20-year, 10-year, 5-year, almost any time period you could think of. My index outperformed.
If you think about the traditional style indices, right, value versus growth, growth tended to do better when money was cheap, financing was cheap. So there's certain economic circumstances and market environments where different types of investing do well. Do you think that's the case with your index? Are there market environments where it should particularly shine and ones in which it should not shine as much?
Definitely. So I'll give an example. Sure. So in Europe, the average top 10 market cap company was founded in the 1920s. In the US, the average top 10 was founded in 1985. So the point is, when there is innovation, leaders changing, my index will do better. When there's old legacy companies just sticking around, so for example, the energy sector, or communications, where AT&T and Verizon have been around for like 100 years. Same thing with Exxon and Chevron. So my index probably wouldn't do as well relative to market cap weighted. But in an industry where things are changing, innovation's happening, winners are rotating, my index would likely outperform.
How do you kind of weigh fundamentals versus behavioral stuff, right? So taking a look at the market today, you have arguably deteriorating economic environment, certainly through July, yet you still have record inflows from retail investors, right? And so much of market return is some fundamental, some structural things, right? OpEx, liquidity, and behavioral stuff as well. Where do you think inside ownership kind of fits in?
Yeah, well, personally, I've always been kind of a fundamental investor, but the more I've learned to focus on behavioral is when my returns have gotten better. So I think my index, being a passive index, is really geared more toward behavioral. Yeah. Right. And the point of my index is that it's too hard to pick the winners. So you use a passive index and use an index that favors innovative companies with innovative founders. People who wake up in the morning thinking about their companies, go to bed thinking about their companies, and that's what leads to innovation. I think is someone that has like soul in the game. So. That being said, I think the behavioral aspect of investing is like the most important. I think now that more that I think about it, I think like 90% of good performance comes from behavioral, and maybe like 10% comes from being smart. Yeah. I mean, if you look at just a sectional regression of returns, right? If you just do it the way Fama French did it, 3-factor model with size, value, and profitability, it explains a lot of returns, but so much of that can be dwarfed by how momentum does. And you can't really find a sensible reason for why momentum continues to outperform, other than
people just continuing to chase momentum, right?
Right.
And so I guess I tend to agree with you there. So, more generalized, what's one investing myth you still think people fall for?
God, there's a book I read, What I Learned About Investing from Losing $1 Million. That was the name of it. But what he said in there made a lot of sense to me. There's like a million ways to make money in the market.
Yeah.
And I've had my beliefs before, but there's a lot of successful investors in every possible way of investing, whether it's technical analysis, fundamental analysis, trading, swing trading, whatever it is. There's a million ways to make money, but there's really only two ways to lose money in the market, and that's overconfidence and lack of knowledge, really. So it's behavioral.
It's right? It's a pretty good lesson. Who are your favorite thinkers that you read, that you listen to, that you watch when trying to formulate ideas, strategies about markets, about the economy?
Yeah. Well, I've listened to every Berkshire annual meeting since 1994, and I've listened to them maybe at least twice, each one. And some of them I'll listen to maybe 3 or 4 times. So I'm talking about like 10,000 hours of listening to Warren Buffett. So I feel like I could ask him a question about investing and I'll get an answer. I mean, it's in my mind, but I know so much about what he would say. And then the second one is Nassim Taleb. So he wrote the book Skin in the Game, and my index is based on Skin in the Game. Yeah. So I feel like if Nassim Taleb and Warren Buffett sat in a room and had to come up with a strategy for investing, my index would be the one.
What do you think, given obviously a lot's happened in the market this year, certainly 2025 has not been boring. A lot of trends, right? AI, secular growth theme has been the big trend for the past 2.5 years now at this point. Do you think there is something that people are really hyped about that is overhyped? What are your feelings on that?
Well, AI is somewhat overhyped, but like Jeff Bezos said in the 90s about the internet, I think he said that the internet was in a petri dish, meaning that there's some explosive growth going to come, and it's still
probably some good, not some some bad.
But who the winners will be is difficult to tell, I think, So there's a lot of hype, but there will be some extreme winners. And, I think in the next 10 years, we'll get the first $100 trillion company within the next 10 years. And that extreme winner may not be someone that's even founded today, So I think you want a system that could capture that. And most likely, I think the extreme winners will be founder-led. Yeah.
So if people want to get exposure to your index, how would they go about that?
So, they could contact me using my website, insideownership.com. But right now, it's available via SMAs on the Charles Schwab and Fidelity platform. You would have to have a independent registered advisor that could allocate capital to my index.
Okay. Last question, and obviously you would have a lot of advice for your younger self, especially when you were losing your grandma's money. Yeah. And so is there any advice that you've learned throughout the years that you would like to give to that kid who was just interested in stocks and finally getting out of bed?
Yeah, the best advice I can give myself is you're not that smart.
That's good advice. Being humble is so difficult for a lot of people in this world, and particularly in this industry. But I think being humble and understanding that maybe your idea can be improved is a good basis for anything.
Yeah. Lastly, my favorite quote from Warren Buffett is that know-nothing investor can outperform the smart money when you acknowledge your dumb money. So when you acknowledge your dumb money, you allocate capital periodically to indexes, and you cease to be dumb money.
There it is. The man himself. Well, thank you again for joining us today. It certainly seems like a very exciting index, and I'm very excited to see where it goes from here.
Thank you.